Good afternoon and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before we get started, a few quick reminders. Anyone who has registered for today's program will be receiving a copy by the end of this week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Today, we have Ben Alderton, Senior Manager, Credits and Incentives at MossAdams. Ben, I know you have a lot to get to today, so I'll let you take it away.
Great. Thanks a lot, Rachel. Good afternoon or morning, depending on where you're at and watching this. I'm going to cover, the topic I'll cover today is related to the Inflation Reduction Act and opportunities for auto dealers. And I'm going to try to hit on just a few of the ones that I think are sort of key or something that maybe keys in. The Inflation Reduction Act is a large bill. It has a lot of different provisions in it, a lot of opportunities related to green energy. But one of the things it did was create an unprecedented opportunity for the transition to green energy in manufacturing. And it created incentives for both for-profit and not-for-profit businesses, which is something that's pretty revolutionary. And there's a 10-year lifespan of these incentives. It was originally estimated to be in the neighborhood of $370 billion. But as we're seeing the uptake of projects that are interested in pursuing credits and others that are interested in transferring credits and other things associated with that, the incentives are probably going to be much larger by the time everything is said and done over the course of this 10-year period. And as I indicated, I'll try to hit on just a few of the ones that I think are really hot topics, but there are a number of different credits that would be available or that are available for various businesses and various opportunities that you may or may not be looking at. So I encourage you to take a look to see if there's something that you're doing related to green energy. It probably behooves you to see if there might be a credit or some other incentive out there that you might be able to take advantage of. One of the other large changes in the Inflation Reduction Act was it provided a mechanism for a one-time transfer of credits to a third party. So traditionally, in order for a normal taxpayer to receive credits or get credits in the open market for projects that they weren't necessarily constructing, they had to invest in those projects through a partnership. And this partnership was known as tax equity, and it's quite complex. It requires a lot of complexity as it relates to entering that partnership, the underlying due diligence as it relates to the renewable energy asset, maybe a solar panel or solar field or something along those lines. And additionally, the accounting wasn't so straightforward as it related to what the impact of that transaction, where that was taken on the balance sheet and how things looked as it related to that balance sheet. Now that we have this mechanism of transfer in the code, it actually is something that's it's quite simple. It's similar to what we see for state tax credit transactions, whereby you basically, for something less than $1, purchase credits, and that the credit that you purchase then can be utilized to offset your own tax liability. And it greatly reduces the complexity of tax equity structures, and we'll talk about that in a little bit more detail as we go forward. As we talk about the opportunities in the Inflation Reduction Act, it generally applies to projects that placed in service after January 1st, 2023. That's when we saw the reauthorization of many of the credits in the take effect, as well as the expansion of some new credits, such as hydrogen production and other credits like that, or advanced manufacturing credits. The couple of credits that I'm going to kind of highlight today in terms of credits that maybe auto dealers can take advantage of that we see from our clients of questions that are coming to us and what it looks like, and asking these questions about specific credits are the two credits that I have here on this slide. Specifically, the 30C that refers to the IRS code 30C, alternative fuel vehicle refueling property, or as I think of it, EV charging stations. Its credit is transferable. We'll talk about the credit enhancements here. And each of these credits that we talk about, also to the extent that you would purchase or transfer or utilize these credits, it does have a 3-year carry back and a 22-year carry forward to utilize the credits. The other credit that we see is the Section 48 investment tax credit. And this is what you typically think of as it relates to if you're going to install solar, for example, on a building, or maybe use carport solar or something along those lines. That's typically what you see, but it could be other technologies such as geothermal, there's microgrid, there's other technologies that might qualify for this investment tax credit. And we'll talk again more about this in just a minute, but it's essentially a credit that if you build it, you're entitled to it, sort of thing. So it is a credit that's based on the amount of qualifying costs that you put into maybe installing a solar panel or something like that. Again, we'll talk about the eligible credit enhancements here in just a minute. So as I indicated, we'll start with the alternative fuel vehicle refueling property, or EV charging stations, as we typically think of it. The amount of the credit starts out as it relates to non-depreciable property. So this would be personal property, is 30% up to $1,000 per item of qualified property. That's not something that gets too many people excited, but what does get some of our auto dealer clients excited is it relates to depreciable property, or property that's used in business. So it's a 6% credit up to $100,000 per project. And then associated with that, and a 6% credit doesn't usually get people too excited either, but it's better than nothing, obviously. But then associated with that, there's a 5 times multiplier that if you meet prevailing wage and apprenticeship requirements would qualify. So it can be a 30% credit up to $100,000 per item of qualified property. We'll talk in just a second about the prevailing wage and apprenticeship requirements. It is important to note that the statute doesn't have a de minimis exception. If you look at related to solar, for example, if your investment tax credit on solar, if you're under 1 megawatt inside, you can be exempted from the prevailing wage and apprenticeship requirement. There is no similar de minimis amount on the EV charging stations. The other key factor is that you must be located in eligible census tract. What is an eligible census tract? There's 2 ways that that's defined. The first is a low-income census tract under the new market tax credit regulations. It's a census tract that has a poverty rate that is greater than 20%, or a median family income of less than 80%, are the 2 basic qualifications based on that census tract. The other one is being located in a non-urban census tract, which we generally think of as a rural census tract. Fortunately, you don't have to try to parse through all of this to get a quick idea as to whether or not your location qualifies. The Department of Energy does maintain a mapping tool. I've got a link here in the presentation to that mapping tool. So you can go in and kind of run a quick address search and see if you fit within the requirements of those 2 being located in that eligible census tract. So one of the requirements, as I indicated, to get that 5 times multiplier is that you need to meet prevailing wage and apprenticeship requirements. And kind of this slide talks through a little bit about what that means. So the prevailing wage requirement is something that is in the IRA as it relates to 30C property and larger solar ITC projects. Requires that wages be paid at the prevailing wage for similar work at a project, and it's determined by the Department of Labor. If you're familiar with government contracting, this is similar to Davis-Bacon rules as it relates to government contracting. And additionally, you have to have qualified apprentices that are paid a percentage of the prevailing wage that's kind of consistent with their completion of their apprenticeship program. And then there is this apprenticeship requirement that you have to have a certain number of apprentices on the site and working, and that minimum percentage in 2024 and after is 15%. So in order to qualify for that 5 times multiplier to get you to that 30% credit, it requires compliance with both the prevailing wage and the apprenticeship requirement. And we look at this as being done during construction. It's the workers that are there on the job site installing the applicable credit property. And we'll talk a little bit more. I'll show you an example as it relates to the multiplier for prevailing wage here in just a couple of slides, because it also is a multiplier that is applicable to the investment tax credit, but in a slightly different way. The next credit type we'll talk about is that investment tax credit. As I indicated, this is what you typically see or you think about if you're going to do a solar installation on a building or maybe carports or something along those lines. So this is what we typically think of. It's different than the production tax credit we'll talk about in just a second, where the production tax credit is based on the production of electricity. So you typically you see that actually pay out when you have larger projects, the production tax credit versus the investment tax credit. That credit percentage for the investment tax credit starts at a base of 6%. Again, not too exciting, but it can go as high as 70% if you meet all of the different requirements that we'll talk about here in just a minute. And it is a little bit of a unicorn type of project that meets all of those requirements, and you'll see as to why that is to get to that full 70%. But it's not unreasonable for a project to get to 30, 40, or maybe even 50% based on meeting those all the various qualifiers. And the credit is available in the tax year when the project is placed in service. So it depends on your tax year, but let's say you're a calendar year taxpayer and you place the project in service in December of 2024, you would then claim it on your 2024 tax return. The investment tax credit does have a 5-year recapture period that's associated with it, so you do have to maintain the system. It has to be in operation, and you have to just meet some basic requirements as it relates to that system being in production for that full 5-year period. As I indicated, there is a production tax credit that is under Section 45 of the code, but that is related to the production of electricity. That one's earned over a 10-year period. But it doesn't have that recapture that's there that you might see on the ITC, because its credit is earned based on the production and sale of electricity each year. So this is a slide that kind of shows you the stacking of all these different tax credit enhancements that are possible. And it really is designed to show you as stacking one on top of the other. We start down at the bottom with that 6% credit. If you then meet prevailing wage and apprenticeship that we've kind of already talked about, if you meet those requirements or you're exempt from meeting those requirements, there is a 5 times multiplier. As I indicated for the 30C credit, there is no exemption from PWA requirements. But on the investment tax credit, if a project is less than 1 megawatt in size or began construction within 60 days after the first regulation, so actually before January 28th, I believe, of 2023, then you can be exempt from prevailing wage and apprenticeship. So what we see oftentimes, if you're talking about rooftop solar or something like that, you're usually well under that 1 megawatt exception, and so you can qualify automatically for a 30% credit based on that. And kind of as a rule of thumb, not anything that you can take to the bank by any stretch of the imagination, but a rule of thumb is about 6 to 8 acres for it equals 1 megawatt of solar panels. So you do have to have a fairly large installation to get over 1 megawatt. But if you are exempt or meet that requirement, you go from a 6% credit to a 30% credit. The next bonus that is on there is domestic content. This is a requirement that if all of the structural steel and iron is made in the USA, and then 40 to ratcheting up to 55% of the manufactured products are made in the USA. So if we're talking about solar panels, you'd be looking at the structural steel and iron, what's supporting those solar panels, and then you'd be talking about the solar panels themselves, the inverters, and other manufactured products. If you meet those requirements, your project would then qualify for an additional 10% bonus. So you could take that 30% credit and go to 40%. And then the next one is being located within an energy community. And that is a 10% bonus that, again, if you look at that mapping tool that I referenced earlier, it can help you determine if you're in the Department of Energy maintains a mapping tool, and you can determine if your location is located within an energy community. The two ways that we predominantly see meeting energy community is if you're in a census tract or an adjoining census tract that had a coal-fired power plant that closed within a certain period of time, or if you're located in an area that traditionally had a certain employment percentage related to fossil fuels, and that census tract also has a higher than the national average unemployment rate. So those things that can fluctuate just a little bit. That unemployment rate data comes out each year, probably in about May. It should come out for this next year. But if you begin construction in that energy community, you stay in that energy community, you get that 10% bonus credit. The third way you can qualify for the energy community is being located, if your project is located on a brown field or has other environmental contamination. And that can get you up to that 50% credit. And those are sort of credits that are as of right. If you meet the requirements for each of those steps along the way, you would get to that 50% credit. And you don't have to meet the domestic content. You can meet the prevailing wage and apprenticeship and the energy community and get a 40% credit, but they do stack on top of one another as you move up. The last two are the ones that require an application. So they're what we call the environmental justice allocation, and they're related to whether or not you're located in a low-income community or on tribal land or benefiting the low-income community as well. So maybe an affordable housing development is where you'll see that 70%. And so you apply for that additional allocation before your project is placed in service. And if you're awarded a piece of that allocation, then you can receive those bonuses. And so that's why I said it takes the right project to get all the way up to 70%, but it is possible to reach that number. All right, so I'm going to switch gears with just a little bit and talk about some of the other part of the Inflation Reduction Act that could be of interest to some of you out there. Is it relates to the transfer of credits. So potentially, as I indicated before, we had a kind of a complicated mechanism. If you wanted to lower your effective tax rate, you needed to enter into a tax equity structure and take those credits out of a partnership that you would have formed. With the transferability requirements, we can now make it much easier for you to reduce your effective tax rate if you meet kind of some of the qualifications as it relates to that. So the IRA transfer, the credits generated in the IRA offset corporate income tax. There is some considerations related to global minimum tax and then the business credit limitation of 75%. So you can't offset more than 75% of your liability with these tax credits. One of the biggest things that we see kind of tripping some individuals up, and specifically S Corps up, is there is passive activity rules that limit the use of the credits for individuals and S Corps. So to the extent that you have passive income, the credits can offset that passive income. However, if you have active income and you're an individual or an S Corp, it may be that you're limited in the ability to utilize credits. Additionally, there may be some state tax implications on transactions. However, within the IRA itself, the gain as it relates to the sale of credits or the reduction in your estimated tax liability. Maybe you buy a credit at 93 cents and get $1 worth of credit. That 7-cent difference is actually not taxed or considered federal taxable income. And then additionally, buyers can take advantage of these credits for purposes of estimated tax payments. So if you know you're going to purchase credits and you take the position that you're going to reduce your tax liability based on those credits, you can offset a portion of your estimated tax payments as well. You do have to be a little bit careful because any shortfall in those purchases can result in underpayment penalties and interest if you fail to meet, if you think you're going to require X amount of credits and you receive fewer credits than what you anticipated. So what's the process look like? This slide and the next slide is intended to show you what that credit transfer process looks like from the seller side of the equation and the buyer side of the equation. On the seller side of the equation, you're going to generate your credit. You're going to determine whether or not you want to pursue an ITC or a PTC, an investment or production tax credits. And you're going to look at the tax credit enhancements that you might qualify for, and then you're going to want to validate that credit. Then you're going to identify a buyer as it relates to, and your negotiating points are always related to price, payment terms, whether or not tax credit insurance is required, or whether or not you're going to give a guarantee, and then execute either a letter of intent and a PSA, or just move to the straight purchase and sale agreement with your respective buyer. Once you've entered into that, you're going to register the credits. This has to be done after placement in service of the credits, but has to be done prior to filing for the credits on a tax return. So an electronic registration number is generated by the IRS, and this is really designed to prevent fraud and abuse and allow the IRS to sort of tick and tie that this credit is associated with this IRS registration number. And then it's as easy as filing the applicable tax returns and including it on the Form 3800, and then also transfer election statement being filed when you file your taxes. This is the slide, as I indicated, as it relates to the process for the buyer on the buyer side of the transaction. So you want to look at some of the considerations early on as determining your eligibility. You need to think about the C Corp and passive activity rules and limitation of liability that exists there. Determine whether or not this is a one-time need. Perhaps you've got a large taxable event in 2024 and you want to offset some of that with credits, or you just know you're going to have a steady tax liability and you want to kind of get into a purchase plan that's associated with that. And then you want to evaluate the different credit opportunities. We talked a little bit about the ITC, or the investment tax credit, versus the production tax credit. Which one's right for you as it relates to recapture and other things that are associated with it, and price. What's the price of the various types of credits that you're going to get? And also an area where we see a lot of negotiation is around payment terms. When do you make a payment for the credit? Then you want to identify the seller and validate everything that's associated with that. This kind of it's almost a mirror image of the seller side. You're going to validate their credit enhancements and the generation of their credit. Look at that guarantee or tax credit insurance and execute an LOI or purchase and sale agreement. And then once that's done, you then will take that registration number that the seller has generated, put that on a tax return, and claim your credit along with that transfer election statement that we talked about as well. So the process pretty much mirrors that of the seller, just have a few different considerations that you need to think about as you're moving through the process. And with that, I have reached the end of my slides. So I don't know, Rachel, I'm pretty close to the time we talked about. I don't know if there's some questions that came in that we can address.
There is a question that came in, and I will read it for you. To get the 30% credit for EV chargers, what is the supporting documentation needed for the prevailing wages and apprenticeship qualifications?
That is a great question. It's one that is a little bit of a loaded question, because what is out there in the regulations as it relates to prevailing wage is you do need to keep documentation and have documentation to support your claim that the laborers met the requirements. And additionally, if you have if you kind of validate and go through that process at least on a quarterly basis, and there's an error and there's an incidence of where you didn't someone wasn't paid the right wage or something along those lines, you can correct that error and not have as much of, or either have a reduced penalty or no penalty if you're kind of making a good faith effort to monitor that as you go through construction. So as you're thinking about that, I encourage you to consult with someone that can advise you specifically as it relates to that, and kind of talk through what sort of reporting that you want to keep as it relates to that. But it's generally, you'll need to keep all the business records of that to be able to support that credit. Ultimately, with any of these various credit enhancements, at the end of the day, if the IRS comes knocking and says, show us your work, you want to be able to show that proof behind that work that exists. Hopefully that answers the question in a roundabout way. I realize it's not a direct answer, but it's a little bit dependent on your circumstances.
Well, Ben, thanks for joining us today. This was some really helpful information. If anyone else has any questions for Ben, you can send them to me and I will pass them along and get you guys in touch. Again, you will all be receiving a copy of this webinar by the end of this week. To those on the line, join us back here Tuesday, May 14th at 2 p.m. Eastern as Strategic Source shares 4 proven steps to new profitability. For more information about AIADA, visit aiada.org. Thanks for tuning in and have a great day, everyone.